macro currency signals.
There comes a moment in history when a system does not gently evolve, it fractures, not because people want it to, not because politicians decide it, but because the math breaks, because trust collapses, because reality catches up with decades of denial. And when that moment comes, the asset that was mocked becomes the asset that defines survival. We are approaching that moment now. For decades, the global financial system functioned on a single assumption, that debt could grow faster than production forever, that promises could expand faster than output, that currency could be created faster than value, and for a while it worked. Asset prices rose, credit expanded, consumption replaced productivity, financial engineering replaced industrial dominance, nations stopped building and started borrowing, corporations stopped producing and started leveraging, governments stopped balancing and started printing. But debt is not growth, it is future growth, pulled into the present. And when you pull too much from the future arrives empty. We are now staring at that emptiness. The industrial base that once defined economic strength has been hollowed out. Supply chains that once ensured resilience have become fragile webs stretching across political fault lines. Entire generations have been raised in a financialized economy where speculation felt more rewarding than production. And layered on top of this is an unprecedented mountain of obligations, unfunded liabilities, sovereign debt, corporate leverage, consumer credit, stacked so high that even modest interest rates begin to suffocate the system. This is not cyclical. This is structural. And when a structure begins to fail, the response is always the same. Retreat inward, protect domestic capacity, secure resources, reinforce borders, reclaim manufacturing, prioritize self-sufficiency over integration. The language changes, the tone changes, the policies change, but beneath all of it is the same underlying admission. The old model cannot continue. Before we go any further, if this breakdown is resonating the way it should, make sure you're subscribed and that notifications are turned on. In environments like this, timing matters. Being early isn't a luxury, it's the edge. Drop a comment below and tell me where you're watching from and what time it is on your side of the world. This conversation isn't confined to one country or one market. It's global. And seeing how far this reaches says more than any headline ever will. Now understand what just happened. A reserve currency sounds like a privilege, and for decades it was. It allowed deficits to expand without immediate consequence. It allowed consumption to exceed production. It allowed financial markets to dominate real industry. But every privilege carries a hidden cost. A reserve currency must remain strong. A strong currency makes exports expensive. Expensive exports hollow out manufacturing. Hollowed out manufacturing weakens national resilience, and weakened resilience forces reliance on debt. At first, the world funded that debt willingly. It recycled trade surpluses back into bonds. It treated paper promises as if they were gold. But confidence is not permanent. Confidence is conditional. And once trust begins to erode, even slowly, the shift becomes exponential. Trust is the invisible foundation of fiat systems. Remove it, and everything trembles. Look at what is happening globally. Nations are diversifying reserves. Trade is increasingly settled outside traditional settlement channels. Alternative payment rails are gaining adoption. Bilateral agreements are replacing multilateral dependency. Strategic commodities are being stockpiled. Industrial policy is returning. Mercantilism is quietly replacing globalization. This is not ideology. It is survival. And beneath this macro shift lies a deeper realization. When the world fragments, tangible assets matter more than financial abstractions. Energy matters, food matters, rare earths matter, copper matters, and silver matters. Silver is not just a metal. It is an industrial backbone. It is embedded in electronics, solar infrastructure, medical applications, defense systems, advanced manufacturing, and emerging technologies. It sits at the intersection of monetary history and industrial necessity. For thousands of years, it functioned as money. In the modern era, it became a commodity. But as monetary instability rises and industrial demand accelerates, its dual identity becomes its greatest power. Most investors still view silver through outdated lenses. They compare charts, they debate ratios, they argue about overbought conditions, but they miss the structural transformation unfolding beneath price action. Price is the last signal. Structure is the first. For decades, silver pricing operated in a system dominated by derivatives. Paper contracts dwarfed physical supply. Leverage defined discovery. Synthetic supply suppressed volatility. And because most participants never intended to take delivery, the illusion persisted. Volume created the appearance of liquidity. Liquidity created the appearance of abundance. But leverage is fragile, and when confidence in financial architecture weakens, the demand shifts from paper claims to physical possession. Delivery matters. When physical demand rises consistently over time, it begins to strain the system. Inventories tighten, premiums widen, hedging costs increase, refiners face margin pressure, short positions become riskier, and slowly, quietly, the market transitions from price discovery through leverage to price discovery through scarcity. Scarcity is not loud at first. It is subtle. It shows up in longer wait times, in higher premiums, in inventory drawdowns that analysts dismiss as seasonal, in margin adjustments that appear technical but signal stress. It shows up in industrial buyers securing supply far in advance, in governments labeling metals as strategic, in exploration incentives quietly increasing. The mainstream narrative rarely acknowledges these signals. It focuses on consumer sentiment, quarterly earnings, and speculative technology valuations. But beneath that surface noise, physical metal is moving, quietly, persistently, and then there is the monetary dimension. Every fiat currency in history has followed the same trajectory: birth, expansion, overextension, debasement, collapse, or reset. Not because of malice, but because the incentives of debt-based systems inevitably favor expansion over discipline. Politicians prefer growth to austerity, voters prefer benefits to cuts, markets prefer liquidity to contraction, and central banks, when confronted with crisis, prefer stimulus to collapse. So when the next liquidity event hits, and it will, the response will not be restraint. It will be acceleration. A major banking stress, a sovereign funding scare, a derivatives unwind, a global dollar squeeze. It could take many forms, but the pattern is consistent. Liquidity evaporates, asset prices wobble, credit markets tighten, and policymakers intervene. At first, intervention stabilizes. Then it expands. Then it overwhelms. Monetary authorities have one primary tool: currency creation. They can suppress rates, they can purchase assets, they can guarantee liabilities, they can inject reserves, they can extend swap lines, they can provide emergency facilities, and they will. Because the alternative, deflationary collapse of a debt-saturated system, is politically and socially intolerable. But every intervention carries a cost, and the cumulative effect of repeated interventions is currency dilution. Currency dilution does not always appear immediately in consumer prices. Sometimes it appears first in asset prices, sometimes in housing, sometimes in equities, sometimes in commodities, and sometimes, after years of suppression, it appears explosively in monetary metals. Silver's historical volatility is not weakness. It is leverage to monetary instability. It is smaller in market size than gold. It has deeper industrial integration. Its supply growth is constrained by geology and capital intensity. When monetary demand converges with industrial necessity, the move is nonlinear. Consider the structural supply dynamics. A large portion of silver production is byproduct, mined during extraction of other metals. That means primary silver supply does not respond quickly to higher prices. New projects require years of exploration, permitting, financing, and development. Capital expenditures rise as ore grades decline, environmental regulations tighten, energy costs fluctuate, political risk increases in key jurisdictions. Demand, however, is accelerating. Electrification initiatives require silver for conductivity. Solar expansion consumes substantial ounces annually. Advanced electronics and medical applications add incremental pressure. Defense infrastructure requires reliable supply. As geopolitical tensions rise, nations prioritize domestic control over strategic inputs. This is not speculative demand, it is structural. Overlay that with monetary demand returning due to declining trust in fiat systems, and you create a convergence rarely seen in financial history. Now consider valuation. When financial analysts model gold relative to global monetary aggregates, the implied repricing levels are dramatic. If even a modest portion of global base money were to be explicitly or implicitly linked to gold reserves, the nominal price would need to adjust significantly. Silver, historically correlated but more volatile, would not remain static in such a scenario. Markets do not move because people hope they will. They move because structural imbalances resolve. And silver's imbalance has been building for years. Public ownership remains minimal relative to other asset classes. Institutional allocations are tiny. Pension funds hold negligible exposure. High net worth portfolios often treat precious metals as optional rather than essential. Yet central institutions globally have been increasing gold reserves steadily. That behavior signals strategic positioning. Retail participation is not what drives generational moves. Structural capital does. When the next liquidity crisis forces aggressive monetary expansion, confidence will not reset automatically. Each cycle of intervention diminishes credibility. Each balance sheet expansion reduces faith in long-term purchasing power. And once enough participants recognize that fiat supply is elastic while physical metal supply is finite, allocation shifts accelerate. Silver's market size is small relative to global financial assets. That small size is precisely what makes it powerful. When even a fraction of institutional capital reallocates, price discovery becomes violent. Millionaires are not created because price ticks up modestly. They are created when asymmetry meets timing, when an asset suppressed by structural mechanics revalues into a new paradigm. The coming years represent not a typical bull market, but a potential regime change, a shift from debt-dominant confidence to asset-backed credibility, a shift from globalization to strategic nationalism, a shift from paper leverage to physical security. Silver sits at the intersection of all three. If currencies are diluted to preserve debt systems, silver benefits. If industrial reshoring accelerates, silver benefits. If geopolitical fragmentation increases stockpiling, silver benefits. If trust in institutions erodes further, silver benefits. And here's the part most investors miss. These forces are not isolated. They reinforce each other. Monetary instability drives physical demand. Physical scarcity drives price pressure. Price pressure attracts capital. Capital inflows accelerate volatility. Volatility draws attention. Attention triggers broader allocation. At some point, the narrative flips. What was dismissed as archaic becomes strategic. What was labeled volatile becomes protective. What was considered speculative becomes essential. But before that transition completes, there will likely be turbulence. A liquidity crunch could temporarily strengthen the currency as global debtors scramble to service obligations. Asset prices, including metals, could experience sharp corrections as leveraged players liquidate. Volatility will test conviction. Headlines will declare bubbles bursting. Analysts will cite technical breakdowns. And yet, corrections within structural shifts are not reversals. They are pressure tests. The difference between a trader and a long-term allocator is understanding context. A trader reacts to price. An allocator studies structure. Structure today suggests that the existing monetary order is straining under cumulative excess. It suggests that diversification into tangible assets is not speculation, but prudence. Silver's historical gold-to-silver ratio fluctuated widely depending on monetary regimes. During periods of strong monetary metal demand, silver often outperformed dramatically. During suppressed environments dominated by financial leverage, it lagged. We are transitioning between those environments. When delivery volumes consistently rise, when inventories trend lower, when governments classify metals as critical, when industrial demand expands, and when monetary authorities prepare for aggressive intervention, these are not isolated data points. They are puzzle pieces forming a coherent picture. The picture is this: the world is moving toward a reset of trust. Resets can occur through inflation, default, restructuring, or repricing. The least politically destabilizing path historically has been repricing of hard assets relative to currency. That allows nominal obligations to be honored while reducing real burden through devaluation. In such scenarios, monetary metals re-anchor systems. Silver's role may not mirror its past exactly, but its properties, scarcity, divisibility, industrial utility, historical precedent, position it uniquely for a world where both technology and trust are in flux. The question is not whether volatility will occur, it will. The question is whether the underlying drivers are strengthening or weakening. Debt levels are higher than at any point in modern history. Geopolitical tensions are rising, not falling. Industrial policy is expanding. Monetary credibility is eroding incrementally. Physical metal flows are persistent. These trends are not reversing. When you step back and remove daily noise, you see convergence, and convergence creates inflection points. Silver investors who understand this are not gambling on hype. They are positioning within asymmetry. They recognize that in a debt-saturated system facing structural recalibration, finite assets hold optionality that infinite currencies do not. By 2026, the compounding effects of monetary expansion, industrial demand, and strategic allocation could intersect in ways few currently anticipate. Not because of fantasy projections, not because of speculative mania, but because the math of scarcity meets the math of debt. And when that collision happens, price is not a gradual slope. It is a revaluation. That is where we stand. Part 2 will go deeper into timing mechanisms, potential catalysts, ratio compression, wealth transfer dynamics, and the psychological phase shift that turns early positioning into exponential outcomes. For now, understand this. Systems fail slowly, then they fail suddenly. Confidence erodes quietly, then it vanishes. Metals move reluctantly, then they explode. And those who recognize the structural shift before the narrative changed are the ones who capture the asymmetry. Now we move deeper, because understanding the structure is only half the equation. The other half is timing, catalysts, psychology, and the mechanics of how wealth actually transfers during systemic resets. Silver does not drift into life-changing price levels. It launches there when pressure that has been building invisibly finally escapes containment. To understand how investors could become millionaires in 2026, you have to understand how financial regime shifts actually unfold. They begin quietly. Credit stress shows up in smaller institutions first. Funding costs creep higher. Liquidity dries up at the edges of the system. Bond markets begin to wobble. Yield curves behave irrationally. Analysts call it temporary dislocation. Policymakers call it manageable. But inside the plumbing of the financial system, stress compounds. Remember, this is a debt-saturated world. Governments are leveraged. Corporations are leveraged, consumers are leveraged, entire social systems are leveraged, and leverage works beautifully until it doesn't. The trigger doesn't need to be dramatic. It could be a regional banking crisis, a sovereign funding scare, a derivatives unwind, a pension liquidity crunch, a sharp spike in energy prices, a geopolitical escalation. Any one of these can ignite the same chain reaction. Margin calls, forced selling, selling pushes prices down, falling prices trigger more margin calls, and suddenly the most liquid assets are sold not because they are weak, but because they can be sold. In that initial phase, silver may drop. Hard, violently. Headlines will scream that the metal was overhyped. Technical analysts will draw breakdown patterns. Social media will declare the bull market dead. But that drop would not be the end. It would be the compression before the detonation. Because once systemic stress crosses a threshold, policymakers do what they have always done in debt crises. They intervene massively. Interest rates get cut aggressively. Liquidity facilities open. Asset purchase programs expand. Currency swap lines extend globally. Fiscal stimulus packages are introduced. Guarantees multiply. Balance sheets balloon. And here is where the psychology flips. At first, markets celebrate the rescue. Equities rebound, credit spreads tighten, volatility subsides. But something subtle changes. Investors begin to recognize that every crisis now requires larger intervention than the last. Every rescue demands more currency creation. Every stabilization increases long-term dilution. Confidence doesn't collapse instantly. It thins. When enough capital begins to question the long-term purchasing power of currency itself, the flow changes direction. Instead of fleeing volatility into bonds, it flees bonds into tangible stores of value. This is the pivot point. Gold moves first because of its institutional acceptance. Central banks accumulate, sovereign wealth funds diversify, large funds allocate modest percentages, headlines begin discussing reserve diversification, analysts debate whether metals belong in portfolios again. Then silver follows, but silver doesn't follow gently. Silver's market size is tiny relative to global capital pools. A single large fund reallocating a fraction of its assets can move price materially. A wave of funds reallocating simultaneously creates vacuum conditions. Now add industrial demand that does not disappear during monetary expansion. Electrification initiatives continue. Infrastructure spending accelerates under stimulus. Defense production ramps up during geopolitical stress. Solar deployment grows under fiscal packages. Technology manufacturing expands under reshoring policies. Silver demand doesn't wait for perfect conditions. It compounds during crisis response. And here is the explosive element, the gold to silver ratio. Historically, during early phases of monetary stress, gold outperforms. It is the conservative allocation, the anchor. But as confidence deteriorates further and capital seeks higher beta exposure to monetary repricing, silver compresses the ratio aggressively. The ratio has spent extended periods elevated when silver was suppressed by leverage and paper markets. But during monetary breakouts, compression can be violent. What once required years can occur in months. When ratio compression aligns with expanding monetary supply and constrained physical inventory, price acceleration becomes nonlinear. Nonlinear moves are what create millionaires. Let's break that down in practical terms. If silver begins a move from suppressed levels and doubles, that attracts attention. When it triples, media coverage expands. When it quadruples, mainstream capital cannot ignore it. At that stage, fear of missing out replaces skepticism. Retail participation increases late. Institutional participation increases strategically. Industrial buyers scramble to secure long-term contracts at almost any price because production cannot halt. Governments begin stockpiling. Export restrictions become possible in certain jurisdictions. Strategic classification intensifies. Supply response lags because mining expansion takes years. Exploration capital floods in, but projects cannot materialize instantly. Above-ground inventory continues tightening. This is how parabolic phases form, not from speculation alone, but from structural imbalance colliding with capital flow. And then there is the wealth transfer dynamic. During currency debasement cycles, purchasing power shifts from holders of fixed income assets to holders of scarce assets. Bonds suffer real losses. Cash loses value incrementally. Equities may rise nominally, but struggle against cost pressures and valuation compression. Real assets with limited supply outperform because they reprice against diluted currency. Silver has historically overshot during these transitions because its volatility amplifies monetary repricing. The investor who positioned early, before headlines, before institutional reallocation, before retail mania, experiences exponential appreciation not because of luck, but because of asymmetry. Asymmetry is when downside is finite but upside expands under systemic shift. The downside of physical silver is limited to its tangible value in industrial use. It cannot go to zero without the collapse of electronics, energy infrastructure, and modern technology itself. The upside, however, expands dramatically if currency units used to price it multiply aggressively. By 2026, the compounding effects of monetary expansion could be fully visible. Consider the timeline. Year 1, stress builds, liquidity tightens, metals remain volatile. Year 2, intervention expands, currency supply accelerates, gold establishes new highs. Year 3, confidence erosion spreads, silver breaks structural resistance levels, ratio compression begins, institutional allocation increases, and when price breaks long-term ceilings that capped it for decades, something powerful happens. Technical traders flip from resistance to momentum. What was once a ceiling becomes a floor. Algorithms reverse bias. Trend-following capital joins. Derivatives positioning shifts from suppression to amplification. That shift alone can drive dramatic upside. Now layer in psychology. Most investors require confirmation before committing capital. They wait for headlines, they wait for validation, they wait for experts to agree, but by the time consensus forms, a large portion of the move is already complete. The early phase feels uncomfortable, it feels uncertain, it feels premature. The late phase feels obvious, it feels safe, it feels validated. Millionaire outcomes occur for those who endure the uncomfortable phase before the obvious one. By 2026, if structural forces align, monetary expansion, industrial demand, ratio compression, physical scarcity, institutional reallocation, the repricing could shock even seasoned analysts. And here's something most overlook. Silver's volatility works both ways. When it moves upward in a monetary breakout, daily percentage swings expand. Pullbacks feel dramatic, but occur within accelerating trends. The speed of appreciation compresses time. Gains that might have taken a decade in normal cycles can occur in 2 or 3 years under regime change. This is not prediction. It is pattern recognition based on historical transitions. During prior monetary disruptions, precious metals did not rise in straight lines. They surged, corrected sharply, then surged higher. Volatility shook out weak hands and transferred metal from leveraged participants to strong holders. The same dynamic can repeat. Another overlooked factor is currency competition. If multiple nations engage in monetary expansion simultaneously to counter economic slowdown, competitive devaluation emerges. Each jurisdiction attempts to maintain export competitiveness. Each increases liquidity. The result is synchronized dilution. When dilution becomes synchronized globally, metals priced in those currencies rise across the board. That global alignment accelerates capital flow into hard assets. And then there is the strategic angle. Governments increasingly view certain metals as critical. Stockpiling initiatives create floor demand. Policy incentives encourage domestic production. Strategic reserves expand quietly. Once metals are considered national security inputs, price floors become politically acceptable. That changes risk calculus. Investors who once feared collapse begin to see institutional backstops. Confidence in long-term value strengthens. At some point, narratives shift from "is silver in a bubble?" to Why didn't we allocate earlier? That is the psychological tipping point. And let's address the word millionaire directly. Becoming a millionaire through silver does not require fantasy price targets. It requires meaningful allocation before exponential repricing. It requires patience through volatility. It requires conviction grounded in structural analysis rather than daily price swings. If silver were to experience a multifold increase over the next 2 years driven by monetary and industrial convergence, portfolios meaningfully exposed could transform. The math is straightforward. When an asset multiplies several times in value, concentrated positions yield life-altering gains. Diversified portfolios with strategic allocation benefit substantially. Those who combine physical ownership with select equity exposure may amplify upside further, though equities carry operational risk. But the foundation remains physical scarcity meeting monetary dilution. The coming environment is not about chasing hype. It is about recognizing that debt-based systems eventually reset through inflationary repricing or restructuring. If inflationary repricing becomes the chosen path, tangible assets absorb excess currency. Silver, because of its small market and dual identity, absorbs it violently. By 2026, the world may look materially different from today. Trade patterns could be more regionalized, supply chains shorter, currency blocks more distinct, trust in supranational institutions reduced, strategic autonomy prioritized. In that environment, hard assets are not speculative. They are foundational, and if the repricing cycle accelerates as stress compounds, the window between skepticism and euphoria could be remarkably short. Those who understand the mechanics will not be surprised. Those who rely on consensus will. The opportunity exists not because of conspiracy, not because of wishful thinking, but because of structural imbalance. Debt has expanded faster than productive capacity. Currency supply has expanded faster than real output. Industrial demand for conductive metals is expanding structurally. Physical supply growth is constrained. Monetary credibility is thinning. These forces converge whether markets acknowledge them or not. When convergence reaches ignition, silver does not whisper. It roars. And in that roar, portfolios positioned early experience exponential transformation. The question is not whether volatility will test conviction. It will. The question is whether the structural thesis remains intact. If debt expansion continues, if monetary intervention accelerates, if industrial demand compounds, if strategic stockpiling expands, then the probability of dramatic repricing increases. And dramatic repricing is how ordinary allocations become extraordinary outcomes. The next 2 years could compress decades of monetary tension into a single explosive adjustment. If that adjustment unfolds through asset repricing rather than systemic collapse, silver stands at the epicenter of wealth transfer. Those watching daily noise may miss it. Those studying structural pressure will recognize it. By 2026, the conversation may no longer be about whether silver can rise. It may be about how high it already has, and who positioned before the move became obvious. And when history looks back at this moment, it won't remember the daily price swings, the arguments on financial television, or the skeptics who demanded perfect clarity before acting. It will remember that this was the window, when debt was unsustainable, when trust was thinning, when currencies were expanding faster than reality, and when silver still traded as if none of it mattered. The opportunity is never obvious in real time. It feels uncertain. It feels volatile. It feels early. But regime shifts reward those who understand structure before the crowd understands headlines. If the monetary system continues down the path it is already walking, if liquidity accelerates to preserve stability, if industrial demand tightens supply while capital searches for protection, then 2026 may not simply be another year on the calendar. It may be the year repricing becomes undeniable. And in that moment, the difference between watching the move and living the move will come down to one decision made before the world finally realizes what silver was becoming all along.